In August 2025, the White House announced a new executive order with an appealing title, Democratizing Access to Alternative Assets for 401k Investors. The public pitch was simple. For decades, average workers have been locked out of the high-yield investment vehicles used by the ultra-wealthy. This policy was framed as a significant win for the middle class, a way to open the doors so your retirement fund could invest like a billionaire does. Right as the government is inviting retail investors to pour their life savings into these alternative assets, the elites who actually run those markets are aggressively warning of an impending collapse. Listen to Lloyd Blankfein, the former CEO of Goldman Sachs who led the bank through the 2008 crash. He recently warned that a lack of discipline has built up, the market is in late stages, and we are due for a total reckoning. Or take Jamie Dimon, the CEO of JPMorgan Chase. Following a string of recent corporate defaults, he invoked his famous cockroach theory. When you see one cockroach, he noted, there are likely others hiding in the walls. If the sharpest minds on Wall Street are bracing for a catastrophic implosion in these exact alternative markets, why is the government suddenly rewriting the rules to give your 401k access to them? To understand what's breaking, we have to look at the aftermath of the 2008 housing crash. Back then, Congress passed heavy regulations that legally barred major banks from making highly speculative, risky corporate loans. But the demand for those risky loans didn't disappear. Instead, a workaround emerged. Unregulated financial firms stepped into the vacuum, offering cash to the exact private companies the big banks were legally forbidden from touching. This practice became known as private credit. This chart shows the private credit market expanding over 15 years into an opaque $3 trillion shadow industry. It was fueled by unregulated firms offering double-digit returns, which attracted a massive surge of institutional cash. Wall Street successfully rebuilt the highly volatile risk pipeline that caused the last major crash. Only this time, they built it entirely in the dark, well outside the reach of federal oversight and public scrutiny. The cracks started showing in late 2025 and early 2026. A sudden wave of bankruptcies swept through the software and artificial intelligence companies that had been heavily funded by these private credit loans. This schematic shows the private credit market's fatal flaw, illiquidity. When a startup fails, institutional capital is trapped. Asset managers don't hold cash. Their money is locked inside these failing companies, making it impossible to convert back into liquid funds. When wealthy investors realized this, they panicked. They began demanding immediate withdrawals from these opaque alternative funds, triggering what is essentially a modern-day bank run. The panic reached so high that even BlackRock, the largest asset manager on Earth, was forced to freeze investor withdrawals. They didn't have the cash. The broader market reacted violently. Blue Owl, a financial firm embedded in private credit, saw its stock plunge by 40% in just 3 months. And here is where the contagion spreads. It turns out major regulated U.S. banks are quietly exposed to nearly $300 billion of this bad debt. Because they couldn't lend to risky companies directly, they lent their money to the private credit firms instead. If the shadow firms go bankrupt, the big banks take the hit. Wall Street realizes they are trapped in a burning building of illiquid debt. To survive the blaze, they desperately need a substantial, immediate influx of outside cash. Which brings us right back to that August 2025 White House executive order opening up 401k investments to alternative assets. This policy didn't emerge out of nowhere. It was heavily lobbied for by Wall Street donors, including Stephen Schwarzman, the CEO of Blackstone, whose own firm suffered a 30% stock plunge due to its private credit exposure. They were looking for a lifeline. For Wall Street, your 401k represents exit liquidity. By offloading toxic, failing assets onto unsophisticated retirement funds, the original investors can cash out safely, while the public absorbs the risk. If this private credit and tech bubble fully pops, it will drag down the entire stock market. Economists estimate that with the broader economy already struggling, the collapse of these inflated tech and shadow finance sectors would likely lead to a severe recession. The complex mechanisms of high finance have evolved since 2008, but the core strategy remains identical. When the risky bets fail, the elites rewrite the rules to safely cash out, leaving the American worker to hold the bag.